Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Monday, June 5, 2017, looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And the market since Friday around lunchtime has really traded in a very narrow range. So all day on Monday and about half the day on Friday, the market traded in about a 65-cent range, which is about 6.5 S&P points. And you can see here that if I just draw these parallel lines here, you can see just the bottom and then the top. There's 65 cents in there from top. From top to bottom is 65 cents. The actual range was narrower than that for the most part, minus a spike here and a spike there. So with that being said, it looks like we've entered into what's also known as the summer doldrums. But they won't be so dull if you just give it some time. But over the next, I would say, 2 to 5 weeks or so, you're going to expect light volume, some back and forth, some grinding higher, a couple of down days, and that's really not much other than that is what I'm expecting for the next several weeks. Unfortunately, that's the way I think it's going to be. However, once we get into the July timeframe, I'm expecting the volatility to pick up. And with the volatility pickup will be a pickup to the downside. And that's when I believe that the bigger correction that will last the majority of the second half of this year will get started in earnest. But we're probably due for some kind of a blow-off top before that happens. So all in all, regardless of whether or not it's a blow-off top or it's a grind higher, either way, there's higher prices coming in these markets before we get any kind of a corrective pattern in earnest. So that being said, whether or not we go up tomorrow or whether or not we go down tomorrow, the net is, other than minor down days, the expectation is for the market to levitate for at least the next 4 or 5 weeks or so. But we are in the zone where a corrective pattern could start really at any time, just not necessarily expecting it, at least in the first part of June at the earliest. And so therefore, I still think there's more upside coming. And when you look at the daily chart, the upside I'm expecting is not that much really distant or too far distant from where we are, $245 to $246 in the SPY. Before it's all said and done, if the market really wants to push higher, it'll get up into 247 and change area. But it's a little premature for that. I don't see that happening anytime soon, meaning within the next several days. So we don't need to concern ourselves with that. But right now, I do think we can push higher over the next couple of days, and I wouldn't be surprised to see some volatility enter back in the market with, there's 2 upcoming events that I have on my radar screen. One is, and this one sounds a little bit ridiculous, but it is what it is, and the market will take a cue one way or the other. And that's Jim Comey, the former FBI director, is testifying in front of some kind of Senate committee or congressional hearing. And therefore, if he decides to open up some kind of a can of worms, and that's going to cause the media to go into a frenzy with Trump again, that could put a spark underneath the market, likely on the downside, not necessarily on the upside. That's item number 1. Item number 2 is we have the Federal Reserve later this month coming out with an interest rate announcement. And the expectation is they are going to raise rates one time or 25 basis points on this session in June. However, anything short of that or long of that could mean extra volatility for the markets. But I don't think we're at that point where we have to start discussing it yet. But just to know that that's on the docket. And I think, if I'm not mistaken, it's next week, Tuesday and Wednesday, with the announcement Wednesday. If I'm wrong on that, it's the following week. But next week is options expiration week, and it would be somewhat apropos for them to have their meeting during the week of options expiration. So that's my take on the overall market. Not a lot has changed. Still going to grind higher. We're in the zone where the cycle is topping, and generally speaking, into the ending of a cycle, the market will trade up into the end or down into the end right before a major cycle is about to turn. And that's what we're seeing here. We're trading up into what I consider a major cycle turn. Now, when you look at the IWM, we saw a nice spike up for the last couple of trading sessions, Thursday and Friday. But Friday, the market the IWM that is, kind of crapped out. We saw a little bit of follow through today on the downside with the spider not really participating. The spider was down 0.1%, but the IWM was down over 0.8%, which is a substantial move, almost 1%. That's different than 0.1%. So with that being said, in the IWM, again, my favorite leading indicator of the market, it was playing catch up last week, catching up to the other markets on the upside with a couple of big up days, really 2.5 days of big up days. If you count Wednesday reversal, big up day on Thursday, and then a nice up day on Friday, but a crap out at the end or last half of the day. And now we see follow through for the downside. Now, maybe this puts in a bullish pattern sideways for another move higher. That's probably the likely scenario. But we also could come back and retest or backtest the 138.60. That wouldn't be out of the question, and it's not that far from where we are today. But just taking it at face value, the IWM, being the leading indicator that it is telling us that there is some downside potentially coming across the other markets. But again, this has been somewhat disconnected over the last week or two from the SPY. So we're going to just watch it closely, but I'm not ready to say, because the IWM was down today, expect a down day tomorrow in the spider. That's not the case. That's not what I'm looking at. That's not what I'm ready to forecast right now. I'm just saying that the IWM was down. It's been somewhat disconnected, so we really need for these two markets to sync back up and for the IWM to once again become the leading indicator and be more predictive than it's been over the last week or two. And that'll sync back up. It's just out of sync for a while, and it generally will sync back up in no time, and that's my expectation. The transports, same routine. The transports were playing catch up last few trading sessions. They started to make a bullish pattern, and then they shot out to the upside. Today, down 0.2, a quarter of 1 percentage point. Not a big deal. Again, could be just going sideways, readying for another push higher. We're not going to read into today's activity. Down 25 points on a $9,300 equity. Not a big deal. We just went sideways in a narrow range. I'm not going to read anything more into that. But the transports did have a good showing at the end of last week, and that does spell for the broader markets higher prices coming. That's what the takeaway would be from the transports. Just looking over at the NQ, which we don't discuss each and every day, but you have to just be a little bit in awe of the move that the NQ had. And again, the reason why I don't like it as a leading indicator of the markets is because of the top heaviness in how this is weighted towards the FANG stocks, for example, Google, Amazon, Netflix, Facebook, and several others that are just the tech bellwethers powering the market forward. You're not getting broad participation across the stock markets. You're not getting the entire market to participate on the upside. This is not a broad-based rally, but it's a narrowly focused rally, specifically in several tech names that are driving the NQ, the NASDAQ, higher. And all-time highs, continues to make all-time highs, just powering forward in an uptrend. No indication that this uptrend is anywhere near ready to break anytime soon. It will, and when it does, it'll become somewhat obvious. We will put in, most likely, a gap and crap day at some point in time. We're not ready for that yet, but at some point in time, we're going to gap higher. We're going to crap out. The market's going to finish on the lows. That's going to wind up to be the reversal that signals everything else across the board, and it's probably going to start in the NQ. You're probably going to see distribution among the FANG names first, before anything else really begins to crack. And that's what I believe is going to be the big signal for the corrective phase that's going to begin in the second half of the year. But we're not there yet. I'm just giving you bits and bytes, tidbits of things that we're going to be watching out for. We have plenty of time. It's never going to be too late. We don't have to be the first person to the party. All we want to be is at the party while all the fun is taking place, and you don't have to be the first one there to achieve that. So therefore, I'm not rushing to be the first person short the market. We're not ready just yet. Okay, looking over at the gold market, what we saw today was a run for the gap fill level. Now, technically, as far as I'm concerned, we did not fill the gap yet. 1286.60, technically speaking, is my gap fill. Okay, that's where I believe a gap is filled. We got as high as 1286 on the button today. That happened early this morning. We traded away from it, traded relatively narrow all day long, but never did technically, as far as I'm concerned, fill the gap. So I think there's still some more upside coming here. And if they do take another run to fill the gap, my guess is we'll go a few dollars higher. But I never like to see when a market comes up really within $1 short, 60 cents short, and trades away from it. It's kind of one of those things where something stinks when that happens. I don't like it. I don't love it. It's not my favorite thing to have happen. If they filled the gap, and I did have orders sitting there waiting to be short the market on that gap fill, at minimum for a scalp trade, most likely, or at least the indication from what I was planning on, was to have some of it turn into a scalp trade and then some of it for a longer term short that lasted either the rest of the day or even into days with an S, plural, on the side. So that didn't happen. I never did get filled. And on the second time up, if we did come up to satisfy that and fill the gap at 1286.60, my guess is, it's not a guess, what I've seen, and I've read this book many times, is that's not necessarily the stopping point anymore because we came so close and pulled away. The likely story is that if we take another run for that level, we go higher first before pulling back. So that's just a little bit of a tidbit from the way I look at these charts and what my expectations would be for the gold market to get back up into that area. Looking over at the silver market, and by the way, everything I just went through with gold relating to that gold chart would relate to any chart with the same set of circumstances or conditions. It wasn't that little lesson about the gap fill and the second time around. That wasn't really focused just in gold. That was focused on what happened on that chart and the fact that any chart where that same setup would happen, I would give you the same story. It didn't have to be limited to gold. It could be any chart under the sun. Silver's in somewhat of the same camp. If silver has another push higher, it'll go up to the 200 period moving average, which is at 1775.76, and pull back from there. It's likely going to follow suit with gold. Whichever direction gold goes in the short run, I guess silver will take the same route. But it's overextended on a short-term basis, and both markets really will need to pull back. But I have a little bit of a head-scratcher with that gap fill hanging out there. That's what I would call an unresolved position for gold, and I think silver and gold are going to banter back and forth until that becomes resolved one way or the other. We could put in a bullish pattern up here, and then that would take the gap fill off the table. The market would be setting up to go higher, and silver would do the same. Or we just rush up there, fill it, and then pull back, and both markets would generally, under those set of conditions, go in tandem. But there's no new information I can add on silver. It's really predicated on what happens in gold. And gold right now, we have an unresolved position. If we look at GDX, and we don't look at this every day, I could build a case that we've got a nice bullish pattern here, right? I can build a case that we've got an up move and we have a bullish pattern, and this would generally set up for a move higher. Now, if we did that, the move higher would stall out at this downsloping trend line, and that would be a third hit of the line, and that would likely send the GDX downward. And if you look at it from a longer term perspective, You see where I'm looking at this trend line here. That's going to be overhead resistance to the market. But the reason I wanted to bring it up tonight, not because of that trend line, but because while we do have a bullish consolidation pattern looking to play out to the upside, we do have some overhead resistance with the 200 period moving average at 23.45 and this trend line. But we also have is a market that, while gold seems to be edging higher, we're not moving higher in GDX. As gold moved higher over the last couple of trading sessions, and if you look at, I'll bring back gold. Actually, this is the GLD. Let me just bring back gold futures, and that wasn't it either. Did I have gold futures up or GLD? What did I bring up just then? Well, here's gold futures. Okay, and gold futures, as it's been edging up, the GDX, and this is the point I want to make, has been basically edging down. And maybe it's building energy for a move up, and that's certainly possible. I wouldn't be shorting it here. So I'm not saying to short it. I'm saying the fact that it hasn't been able to break out of this pattern while the price of the actual metal itself is going up is concerning and tells me that this is likely a bullish pattern waiting to not play out to the upside and fail to the downside. And that's why I wanted to bring this up, because we're not getting confirmation from the price and the metal itself. And generally speaking, if the metal was going to be headed higher, GDX would be a leading indicator of the higher price in the actual metal itself. That's not happening, so I want you to be aware if you're interested in GDX, and I know there are some of you out there that are and like to play GDX. If you are interested, you have to look at it from both angles. Yes, this could be a bullish pattern, but it's not confirming the move that gold has had on the upside, and that has me concerned, thinking that GDX is a false bullish pattern, not going to break out to the upside, and I wanted to bring that to your attention. Next up is crude oil, and crude oil continues to edge downward, and I think we're destined to retest the 45.92. That's what I see in the cards. Maybe it comes up a few pennies short, maybe it pierces through by a few pennies. Either way, I think we're going to be looking for a reversal around the $46 area. That's what I'm looking for at this point in time. I'm not really interested before that unless we see the chart give us an indication and put in some kind of a high volume reversal, a doji candle, something relevant that tells me that there may be a trade to the long side and that we would have something bona fide to trade against on the short side. To trade against, meaning a stop loss against something to trade on the long side. So until and unless we have those type of items in our favor, I'm just going to watch and let it fall, and hopefully it comes down to around the $46 area and puts in some kind of a reversal. Until and unless that happens, nothing doing unless the chart tells us otherwise, and today it's not telling us anything we can do something with. Bonds came into an important level on Friday. We talked about it. It was a retracement looking at the longer time frame from pivot high to pivot low. This was a 382 retrace, also coinciding with the 50-week moving average sloping down. That's the blue sloping trend line. So that being the case, it's a natural area of resistance. The market would generally find natural resistance at a 382 retrace, the 50-period moving average, the same level the chart told you here that level was important. It also told you in throughout here that that level was important and the market was finding support and wouldn't break down out of that level, building a bullish consolidation base to go higher, which is what happened. We came down, busted through it. Now we're coming back up to that same area that was resistance, support, and now maybe resistance again. Either way, it's going to be good for whether it be longer term resistance or only a few days. It has to be resistance to the market. Markets just don't blow through areas like that have all those reasons why they should be resistance. It would be very odd and not normal or uncommon market behavior for bonds to just blow through that area like it wasn't even there. So it stands to reason that we had a pullback from that area when you look at the longer term chart. it appears relatively obvious that the market had to stall out there. Also, we have not quite a symmetrical move, but we had close to the finishing of a symmetrical move. If you begin from this large up candle here, sideways consolidation, you can make a case that this is complete. Either way, it was close enough, maybe complete. I didn't measure it out to the tick. I'm just eyeballing it. And the way I'm doing it is I'm just eyeballing it and saying from this low down in this zone, right? I'm not saying to a tick. From this zone up to this area here, that's about the same as this to this, right? That's pretty close. Maybe this is longer, and that's fine. Maybe you do this from there to here is the same. And when I do my symmetrical moves from a visual standpoint, I may refine it later if I'm looking for an exit of a position or I'm looking for a more refined number for a reason. But when I'm just eyeballing it and saying, and oh, by the way, it also looks like a symmetrical move was completed in addition to those 3 or 4 other things that I mentioned, I don't need the exact number. I can say, from a symmetry standpoint, that's another added benefit that you can see why we were destined to have a pullback around this area. And that's the way I was using it. That's why it's not important to the tick. And that's it with bonds. So whether we put in a bullish consolidation base or we pull back in a more meaningful manner remains to be seen. We'll have to just see what happens over the next couple of trading days, and we'll take it from there. So there's nothing to do with bonds right here, right now. And the dollar really wasn't up, really wasn't down today. It just kind of went nowhere, was up a couple of ticks, but that doesn't count. We're down in this lower end of the range. It looks like the dollar wants to get down to the lower portion of the trend channel. Let it happen, and eventually, sooner than later, we're going to come out of this area with pretty decent force to the upside. It's just a matter of finding that zone where it's going to have the bona fide reversal. Maybe we need some more negative folks about the dollar to hop on board before we see that turn. And once we get maximum or at least more bears on board of the dollar, then we can see a turn at hand. They're usually wrong about 98% of the time, the people they parade on TV. And that's my story. So with that, I'm going to leave it there tonight. It's everything I intended to discuss. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.